All right, we're going to go ahead and get started. Thanks for joining us today for Lighter Capital's second webinar, Revenue-Based Finance, How Does It Work and Who Is It For? We are super excited about the strong turnout for this webinar and aim to bring you valuable insights on what is perhaps our favorite topic, revenue-based finance. My name is Ann Barker. I'm an associate here at Lighter Capital, and I will be on hand throughout this webinar to answer any quick questions you have along the way. I will also collect your more in-depth questions for Rob to address during Q&A. So to get in touch with me, please use the chat and question function on the GoToWebinar dashboard. I will do my best to keep up with your questions, but if there's anything we cannot address during the webinar, we will be sure to answer it after we are done recording. All Q&A, along with a recording of this webinar, will be posted to the Lighter Capital blog before the end of the week. Let me now introduce Rob Belcher. Rob is a VP here at Lighter Capital, and he will be leading our discussion today. He has helped many small businesses seek and secure funding here at Lighter Capital and previously with Voyager Capital, a West Coast venture firm. Like all of us here at Lighter Capital, he's passionate about helping early-stage businesses grow. I will now step back and man the chat board and let Rob take it from here.
Thanks, Ann. As she mentioned, I'm a VP here at Lighter Capital, and just excited to talk to all of you today about revenue-based finance. So thanks for joining us. So first off, a little bit about Lighter Capital. We're based in Seattle, Washington, and our team is serial entrepreneurs, technologists, angels, and former VCs. We've seen all sides of building businesses and investing in businesses, and so we are particularly well positioned for this operation we're running now, which is this alternative financing structure that we think is a really good fit for many, many companies and an alternative that is really needed in the marketplace. We're tech-enabled. We're a specialty finance company. We're a direct lender. We're not a bank. We're not a VC. And we employ this innovative revenue-based finance model for our investments. And like I said, we're tech-enabled. So we use technology to speed up and simplify loan underwriting so you don't have to do all this paperwork like you would at a bank. And then monthly servicing when you make your payments back to us. It's super fast and very easy using our web portal. The goal of today's webinar is to educate all the attendees about RBF as an alternative to traditional debt and equity, and then that section is going to be very broad, and I'm going to talk about RBF as generally as I can because it can be used in lots and lots of ways and very different structures, and so that section will be pretty general. And then I'll spend some time talking more specifically about the way we use RBF and our specific loan structure and our investment criteria and more about our lending program. And like Ann said, if you have any questions along the way, feel free to ping her in the chat or the question box, and we'll get to it at the end during Q&A, or if it's something that's particularly relevant for that given slide, I'm certainly more than happy to make this more collaborative and just talk to questions on given slides. And just to set expectation, this isn't super long. It'll probably be 20 minutes or so, and then happy to spend as much time as there are questions. And then also happy to do some follow-up too. My contact info is at the back of the webinar. So the agenda, like I mentioned, we're going to talk generally about revenue-based finance and who it's for, what it is, how it works, where does it fit, and then more specifically about Lighter Capital and our specific use of the structure. Okay, royalty finance has been around for a long, long time, and it's historically been used for really risky projects that have really high upfront production costs and very low ongoing variable costs with a long tail revenue stream. So oil wells, gold mines, books, movies, that kind of thing, all are typically used actually with revenue-based finance or royalty-based finance, where there's a huge upfront cost, and then like an oil well just sits and pumps oil for the next 15 years or whatever with very low variable costs. So a royalty structure works really well for financing something like that. Obviously very risky though. A book could flop, a movie could flop, or the oil well could be a dry hole, or worst case scenario it explodes or something like that, right? It's all been in the news lately. So high risk, but then really, really profitable down the road with the low variable cost. So how does it work? Different people like I said, use the structure differently, and so it does include some sort of periodic payback. We use monthly, and it's based solely on a % of the company's revenue. More specifically, it's based on a % of the cash collected on a given month for the company. Some people do quarterly, some people do annually, but that's the whole purpose, is that your payments are not fixed like your mortgage or a car loan, and instead flexes with the revenue and the declines and increases in the growth of the company. Okay, so who is it for? And these are mini little case studies, and we've got your typical VC firm, VC-backed company here that has the classic J curve where they spend deeply initially and then come out of the spend growing very, very fast towards an eventual exit. And that is typically a terrible use of revenue-based finance because the company has no revenue usually initially, or even if it does, it is just burning so much cash that a loan or some sort of some sort of bank financing is not applicable. There's just way too much risk for the perceived reward early on. And then obviously there's the possibility of epic VC failure, right? And so there's just too much risk for the reward of the capital cost for a revenue-based finance. However, a company that maybe has a SaaS model or is bootstrapped and has relatively low or flat J curve is a much better fit for revenue-based finance. These companies usually have revenue right off the get-go. They're not burning tons and tons of cash, and they can use a capital infusion to take on a new project or a sales and marketing campaign and really accelerate to another growth level, and then maybe take on another capital infusion and do it again and exit, maybe not for as high a valuation as a VC-backed company, but usually in less time and with the ownership of the company belonging more to the founders and the employees than under a VC scenario where the ownership has been diluted all along. I strongly recommend, if this kind of model or this sort of discussion is really interesting to you, and hopefully it is because you're joining us today. Sorry, this is all new to me. Okay. Then I strongly recommend you pick up a copy of Basil Peter's book, Early Exits. He talks a lot about maintaining equity ownership and exiting earlier for a lower valuation, but with higher ownership, as opposed to taking on VC and being forced into the sort of 10x 7 to 10 year growth period. And it's a really interesting study with some really good data around it too. Okay, so where does it fit in the company life cycle and among other financing options? Revenue-based finance, again, this is speaking generally and not specifically about lighter capital. Revenue-based financing can fit pretty much anywhere a company has revenue. It can be used in a huge variety of ways, and we use it, we'll talk more about this, but usually for fairly early stage software technology companies. There are companies out there that use royalty finance that do $50 million investments into biotech and pharmaceutical companies, which, back to our original use of royalty finance, makes a lot of sense. High upfront risk, high upfront cost, with a really, really low variable cost and long tail revenue stream, with a new pill or a new drug or something. So it can work in a variety of places. And just the biggest thing about it is that obviously it doesn't work for pre-revenue pure startups. And that's where equity and angels and friends and family really are, that's the only place, that's their only capital source at that stage usually. This has never happened before. Sorry about that. Okay. So how does it compare to traditional sources, bank financing and equity on the investor side? And we've heard a term, people have referred to this as dequity, and we think that's a pretty fitting term because it really does fit right in between bank financing and equity venture capital on both the risk side and on the reward side. We charge more than a bank, but we certainly, our potential earning is much lower. Our potential return on our investment is much, much lower than an equity investor. But on the downside, because we are getting monthly payments back right after month one, we're already doing better than an equity investor if the company were to fail. So, but we don't require personal guarantees or any type of recourse back to the investor or the entrepreneur. So if in the case the company fails, we do, we make a little bit of our investment back more so than an equity investor, but certainly are not recovering nearly as much capital as a bank loan without, we have much less protective provisions from a bank loan standpoint. So right in between. But on the company side, the entrepreneur gets the best of both worlds. On the entrepreneur side, if the company fails, like I said, there's no personal guarantee and there's no personal recourse back to management. So if the company fails, it actually behaves much more like equity. But on the success side, if the company succeeds, the cost of capital is actually much closer to a bank loan. Yes, it's more expensive than a bank loan, but it's much, much closer to the bank loan than equity if the company is successful, because the cost of capital for equity is potentially infinite, depending on what the exit valuation is. So on the company side, the revenue-based finance actually is the best of both worlds from a downside and an upside scenario. Okay, let's talk a little bit about Ladder Capital more specifically. We invest in early-stage growing software and technology companies. This is all types of software technology, from SaaS to online digital downloads, games, even integration services and some professional services, as long as there's a product behind it. Our minimum required revenue is 3 months. You must be in business for at least 3 months with $15K a month in sales and growing. And high gross margin, obviously, by definition, if you're in the software and technology space, you're pretty high gross margin. And that makes sense because we're taking our payment right off the top line. So you want a really high gross margin to support that. The company does not have to be profitable, but has to be break-even-ish or on its way to profitability. And we can see clearly that our investment will get you to profitability. We don't do bridge loans. We don't do bridge financing. We don't provide any kind of deficit spending capital. It's certainly not equity. That's not what we do. We like to see that the ownership has a high degree of, the entrepreneurs and the founders and the management team have a high degree of ownership, and especially time-wise, they are very invested in the business. We invest throughout U.S. and Canada, and the use of the funds has to be to grow the business. We don't do debt buybacks. We don't do founder buyouts. And anything, it can be a wide range. It could be even to develop a new product if there's an existing product that's doing quite well and throwing off cash and can support the business. We're happy to lend against a new product development that will help grow the business. But usually the best use of funds is to hire a salesperson or 2 or 3 or take on a sales and marketing campaign. So what is a revenue loan? It's up to $1 million, and the way this metric works is we invest anywhere from about $50K to $1 million, and the limit on how much we're able to lend is 30% of a company's annualized run rate. So say a company's doing about 100K a month or 80K a month, call it $1 million a year. So they're doing 80K a month, which translates into annualized revenues of about $1 million. We can lend about up to $300,000. And the reason for that is because in order to get paid back in any type of reasonable period, we take a % of the revenue. And so if you're doing $1 million a year and we lent you $1 million, just to get paid back our principal amount, we would have to ask for a 50%, 50% royalty percent just to get paid back the principal in 2 years. And that is clearly not sustainable for anybody. So in order to keep that royalty rate down and make sure that the company has the spare capacity to grow, we limit our investment to 30% of the company's run rate. There's no set interest rate. The payment flexes with revenue, and there's no set maturity. And as I mentioned, obviously the payments equal a % of monthly cash receipts. We try and keep that percent in the single-digit range, so anywhere from 1 to 9%. Anything over 10%, we think it starts to become sort of the parasite that kills the host. Like I mentioned, that's why we don't lend more than 30% of your run rate, because we don't want that royalty percent to creep up and become harmful as opposed to beneficial. The loan matures when the cumulative payments that we've received equal some set multiple amount, which is usually 1.5 to 3x. 2x is usually the right number. Most of our deals are 2x. And then we have a very small success fee for upside participation. The success fee here is an important piece. We don't like to consider it as an important piece of the economics of the deal. It is merely a tiny, tiny thing that's meant to be an afterthought that hopefully if you do have a humongous exit down the road, it pays for 1, 2, or 3 defaults in our portfolio. That's it. We're not meant to double dip in your success or anything like that. We're just looking to be to break even on our defaults because we are doing pretty high risk lending. So here's an example loan. A company's doing $1 million a year. We do 200K investment. That translates into a 5% of monthly revenue. And like I said, 2x is really our standard deal. So the company owes us a total of $400K. And then there's a success fee of 2% of the company's sale price upon liquidity event. And that usually also, I should mention, that usually expires when the loan is terminated. When you paid us back the loan, usually a year after the loan has been paid back, that'll expire. The thinking there is, look, if you have an exit while the loan is outstanding, we'd like to think that our money helped you grow and helped you get there and achieve that exit. If you exit within a year or so of the loan terminating, same thing holds. If you sell the company 5 years after you've paid back the loan, at that point you're a totally different company. You got there on your own, and so we shouldn't have claim to any kind of success fee. So it expires. We shoot for a 4-year payback period. So these are all levers, right? So we tweak the principal amount and the monthly revenue royalty amount, the 5% number, such that we get paid back that 2x in about 4 years, which translates into, you can see here, there's about 100% of interest, right? So you owe us $200K on a $200K loan. So 100% interest over 4 years works out to simple interest 25% APR, roughly equivalent. So that's our target. We shoot for 15 to 30% sort of interest rate equivalent. Like I said, more expensive than a bank loan, but we think it's a relatively affordable cost of capital for the level of risk that we're taking with early stage growing companies. I think that's about it on the structure. 4-year payback period. We'll take into consideration your growth and all of that. Like I said, we'll try and keep the principal amount and the royalty amount to a level that helps you grow.
Can I ask a quick question on the slide from the audience?
Sure.
How do you determine the 1.5 to 3x range for a particular company?
Yeah, that's a great question. Oftentimes, like I said, 2x has really become our standard, and that's kind of across the board. But occasionally, if a company is really, really, really adamant about one thing or the other, like I said, these are all levers, the monthly percent, the total cap, that kind of thing. We can certainly adjust these. These are levers. So if you're really, really sensitive to the 2x and you'd like something lower, we're just going to ask for a higher monthly percent. And then vice versa. If you really want to invest the cash and have a lower monthly payment, we'll just ask for a little bit higher, like a 2.25x cap or something like that. So that, our goal is to work with you and make it flexible for whatever your situation is, with our sort of target cost of capital in mind of 15 to 30%. The other thing that drives that cap is risk of company. Earlier stage companies, we might ask for a higher cap just because it's more risky. If you're pretty well established, you're doing $3 million a year and you only want to borrow $100K to hire a salesperson, we'll be on the lower end of our cost of capital side of that 15 to 30% interest rate, just because that's a lower risk deal, depending on burn rate and all that stuff too. There's a lot that goes into it, but generally it's just sort of health and growth rate and situation with the company.
Great.
Okay. Yeah. Okay. So how does Lighter Capital's revenue loan specifically? So we did a little bit of a comparison earlier. And how does the revenue loan specifically compare to bank debt and to venture capital? Like I said, the biggest thing is no personal guarantees. And we do have financial covenants, but we certainly don't have the really restrictive financial ratios and that you have to abide by every quarter or every month with a bank loan. And then on the VC side, we don't have any of the, VCs have no financial protection in some ways because they don't get payments every month. They get limited visibility. I mean, they do have, and they get board seats and things like that. And that's my point, is that they exactly have board seats and equity protective provisions because they have no actual payment or monitoring provisions in place. So we don't have any of those either because we don't need to, because we're a little bit more on the bank side in terms of sort of financial control. But again, limited, right in the middle. Added value, banks maybe tiny bit here and there. They might introduce you to a service provider like a lawyer or something, but basically none. They're a financial institution. On the VC side, this is arguably their biggest advertising point and their biggest value add is this mentoring and introductions, and they will spend a lot of time with you working on your business model and helping you grow. And we're sort of in the middle on this as well. We have taken the range, by definition, like I said, we don't have a board seat, and so we will be completely hands-off. We are happy to be just money and be quiet and act just like a bank. If you are growing and you've got some questions and you want more help and don't have any other angel investors or VC connections or anything, we'll make introductions for you. We'll introduce you to our preferred service providers like lawyers and accountants, and even help with, we've even helped one of our companies structure some of his accounting policies and some of his operating procedures and things too. So we're happy to help as much as you want. It's up to you. Dilution, banks generally none. With venture debt and some of the earlier stage bank debt, they'll ask for warrants, and we're pretty similar on that regard. Our warrants are actually even smaller than what a bank would, like a venture debt or early stage term loan or something would ask for. And then obviously VCs, this is how they get paid. They'll take pretty extreme dilution depending on the stage and that kind of thing. Flexibility, VCs win on this one. They're extremely flexible. They have no payments. They are just equity investors all the way through. We're in between a bank loan and a VC. No fixed payments. Your payments vary. If you have $0 in cash receipts one month, you actually technically owe us $0 as a payment, and that's totally fine. You're not in default. So highly flexible on this front. And then speed. We're very fast. We aim to provide capital very quickly and help you grow and get you off the fundraising track. Like I mentioned at the beginning of the webinar, we all have backgrounds in building businesses or investing in businesses, and we've seen how the fundraising process can derail a company and take, especially if it's a small company, it can take, a significant amount of the resources completely offline for 3 to 6 months as a company raises money. So we've done a deal in as little as 2 weeks. And it's just up to you how fast you want to move and how well organized your docs are and things like that. So the next steps are, if you're interested in financing from Lighter Capital, you can learn more at our website, lightercapital.com, and you can certainly apply online. And then if you have any other specific follow-up questions, you're welcome to email me. And at this point, I think we'll turn it over to questions.
Yeah, I have a couple questions. First off, a couple specific to our Lighter Capital loans. The first is the loan collateralized generally or not?
Yeah, that's a great question. So we do take a UCC filing. It is secured, and usually we're working with companies that don't have other financing in place, so we're usually first in line, senior secured. And so we do work with companies that don't have a lot of assets. So we will ask for all company assets, which usually in the case of the companies we're working with are things like IP, maybe you have a patent, maybe you have some trademarks, and company domain names and code and things like that. What is the chance that we're actually going to go sell any of that stuff if the company goes south? Pretty low. Mostly we take that security as just as a way to, it's one of our only ways to make sure that the entrepreneur stays committed to the company. So that's mostly the goal there, is just the sort of don't quit provision. We just want you to stay working hard for the company, and that's why we take a security position. If the company has existing bank financing, depending on who the bank is or what the financing is, we will often subordinate to it. If it's a formal institution, we will subordinate to it. If it's friends and family or convertible debt from angels, we'll ask to be in front, and that's simply, we don't want to, the whole point is not to screw your angels. That's not the point at all. The point is just if something does go south, it's good to have an institutional investor lead sort of the transaction or lead the workout or whatever's going to happen. We're staffed to be able to work through some transactions or any type of wind down or anything like that. And if angels are in front, we're behind, the process can be a little scary. So it's good for somebody to take the lead on that stuff.
All right, thanks. The next one is, do you have any resources for larger deals, say over $10 million?
Yeah, that's a great question. So like I mentioned when we started with, people use RBF for all kinds of stuff. And we have a network of investors. They behave a little bit more like VCs. They have a fund that they invest out of. We act a little bit more like a bank in some ways. But anyway, we have a network of other RBF quote-unquote friends. And I'd be more than happy to make some introductions if you're looking for a bigger investment or you have a bigger opportunity. And like I mentioned, there's even specific guys out there that do just biotech and pharmaceutical deals. Anyway, so happy to make some introductions. Go ahead and send me an email specifically, and I'll introduce you through to some of the bigger investors. At this point, we're only doing up to $1 million. That may change soon, too, but I doubt we'll ever do anything over $10 million. You never know, but happy to make some introductions.
Okay. More on Lighter Capital. Do you provide additional financing with growth of revenues, like a line of credit?
Yeah, so we don't. It's not a line. It's a really good question. We do not provide a line that you can draw down and pay back and draw down and pay back. We're not really set up to manage that. However, this is a really good question. We have actually done a follow-on investment with well over half of our portfolio. So they've taken an initial investment, they've grown, and they actually have grown revenues to the point where they can take the same amount, say it was 100K, they can take another 100K, and it actually, from a royalty standpoint, is a much lower monthly payment because they've grown so much. So the royalty rate's much lower for the second tranche. So as you grow, we kind of scale along with you. Or vice versa, you can qualify for a lot more financing as you grow too. So we certainly, it's not like a line, but we certainly scale our financing along with you. And the other side to that is when you go out and try and raise equity, oftentimes you try and raise, $6 million because that's your shot. You want to raise as much as you can right now, and then you've got your fuel to grow for the next 12 to 18 months. We're not like that. We actually prefer, for a lot of reasons, and it should be for you guys as well, we prefer to do, say you actually think your total need over the next year is going to be 500K. We'd be really happy to do 250 right now and let you deploy that, put it to work, grow, and then do 250 at a lower cost of capital, like I mentioned, because A, that lets us get to know you, and B, you don't want to be paying for the full 500 if you can't put it to work. So there's really no point, and we're here. It takes 24 hours to close a second tranche. It's very, very fast. So when you decide you want the next 250, we can do that then. We're not like a VC. We're not going to try and jam a bunch of cash into the company. That doesn't do anybody any good with this structure.
All right, sounds good. This is an interesting question. It's a plus to say we're VC-backed with partners and prospects. Can we leverage / name drop your name / financial strength like that?
This is a very interesting question. It's kind of loaded. I guess part of what the?
It's a hard ball.
It's a hard ball. No, it's not a hard ball. I love this. This is the stuff that I talk about all the time. And I, again, would argue you should spend some time on our blog and on our website and definitely pick up a copy of Basil Peters' Early Exits, because he would argue that it is not a plus to say you're VC-backed. And in fact, the analogy I've heard is that basically puts a rocket on your back, and you're either going to make it to the moon or you're going to blow up on the way. And so, I mean, if you think it is a point of pride to say I've raised VC and look what I've done and I've made it, I am somebody, VC's invested in me, that's, I encourage you to do some research and make sure that that's the right brain set for raising money, because like I said, I think it sets you up for a certain path that Basil Peters lays out in his book pretty well, can be pretty rough. So it's not necessarily a plus. It's certainly, there are some advantages. But back to the original question, we are more than happy to, we actually promote our companies quite heavily. We do a lot of PR. We have an amazing PR guy, and we try and get our companies in all the any kind of publication that's relevant for the company, the industry, and everything. Absolutely, we're building a network of companies ourselves. Our portfolio companies can leverage their own services, and we actually use several of our portfolio company services, as do some of our other portfolio companies. They do some product share. So for sure, we try and promote our companies as much as possible, and that goes back to the value add piece. We're not a VC. We're not going to sit on your board. We're not going to spend a whole lot of time, week to week. But if there's anything we can do, we will try and do it.
All right, sounds good. I have a few questions related to accounting for RBF loans. So I think this one covers everything. Would a company treat payments as interest and expense from an accounting standpoint?
Yeah, it's a good point. And this goes back to, so I'll answer this in two stages. One, generally, RBF can be structured in a lot of different ways. So that's something, if this is a sensitive issue for you, make sure you do your research if you're talking to RBF investors and lenders and things, because different people will do it differently. Some people do it as equity with like a preferred stock buyback. It can be all kinds of things. We structure ours more like a term loan with principal and interest payback and an amortizing loan over the 4 years. We provide you with a statement every month. Say you made $100,000 and your royalty rate was 10%, so you owe us $10,000. Well, based on your previous payments and what's left on the loan, we will calculate how much of that is interest and how much of that's principal. You owe us $10,000 as a payment, and then we, on our side, do the math to split that into principal and interest, and then we'll provide that to you as a statement. And yeah, you can deduct the interest from taxes, obviously.
All right, good answer. Here's a question about preparing for RBF financing. What's the one thing you advise companies who apply to really nail to qualify? What's the best thing to prep for?
That's great. And that's actually a really open-ended good question. There is no right answer to this. I think to qualify for our financing, to be a good fit for us, like I said, you've got to be doing at least $15,000 in sales or cash receipts a month for a couple months in a row and growing and not burning tons and tons of cash, relatively break even or a clear path to profitability. Good use of funds. The use of funds has to be to grow the business. It can't be to finish, your beta. That's too risky for us. And then, like I said, not to buy back debt or to do a founder buyout or anything like that. And then on the sort of prepping side, having your company, I know it's like the last thing anyone's thinking about when they're just getting started and building a business, but if you're going to do any type of formal raise beyond friends and family, you really need to have all your organization docs, your corporate docs, and your cap table and your financials in good order. If you are, so something that's really interesting with, especially with SaaS, is the confusion of cash and accrual accounting. So I would actually encourage you to hire a good bookkeeper, if not a full-on accountant, to at least go through stuff before you start doing some fundraising, just to make sure everything makes sense. Because I can't even tell you the number of times we've actually seen financials that they're not nefarious. There's no one's trying to defraud us or anything like that. It's just the entrepreneur is either a business person, a salesperson, or a technologist, and it's certainly not a CPA, and is doing what they know in QuickBooks. But that makes it really hard for us to invest in the company because we just can't tell what's going on with the business. And so I'd really encourage you to make sure that stuff makes a lot of sense and that you're really clear on whether you really are using cash accounting or accrual accounting. And in some ways for SaaS businesses or all software technology, arguably, cash accounting actually is some of the easiest for us to understand because we get a really good sense of what's going in and out of the business each month. Accrual accounting is fine. We can decipher it, and that's totally fine as long as it's done right. And that's where I say that sometimes it's a little bit of a mystery to unravel what's going on, which is just slows everything down and makes it frustrating for you because you know what's going on with your business, but we don't, and you're frustrated because we can't understand it from what you've sent us. So that's one of the biggest things. But just having all of your ducks in a row, and that's actually a good lead into our next webinar that we're going to be doing in a month or so. We're going to go through a lot of this stuff, like what you need to do to prepare for any type of financing, whether it's an equity raise, full angel round, or RBF. So that would be something to listen in on as well.
All right. Another lighter capital focused question. What are lighter capital's advantages compared to other RBF lenders?
That's an interesting question. I would say that the RBF space is young enough that there's relatively few other RBF investors out there, and all of them are doing it differently. So I would say our advantage is, look, we've done 36 loans so far, which is more than anyone else pretty much combined in the RBF space. So we have a lot of experience. We've worked with a lot of people, and like I said, we've done multiple investments with over half our portfolio. So our experience level really, I think, is one of our strong suits. The other thing is we are using technology, so it's really easy and pretty painless. So we really, like I said, we have experience and we know how the fundraising roadshow thing can go, and we like to be able to work really quickly and get you money and let you grow. So yeah, the experience thing is probably the biggest one. I think most of the other RBF investors out there are structured more like a VC fund. It's sort of two people in a fund, and they're doing $1 million to $5 million investments with different structures, different risk tolerances, different criteria. So it's almost not that we're better or worse than anyone. It's just we're different. And if anything, if we ever do compete head-to-head with somebody, it would just be our experience level.
All right. This is a mechanical question about the loan. Is there any way to prepay the loan?
Yeah, so you can prepay anytime, no prepayment penalty. That's absolutely totally okay. If you take in a big equity investment, we can either get paid back out of the equity investment, or we're happy to stay in. Obviously, there's extra capital in the company. It de-risks the loan. That's great for us. It's kind of whatever's up to you guys. If you get acquired, obviously we get bought out. I'm just trying to think of other scenarios. If you have a huge contract that gets paid, that would be revenue, and so that would go towards paying down the loan quickly, very fast. But yeah, certainly if you ever just feel like you want to exit the loan, you're welcome to prepay at any time with no penalty.
Okay, I have one more question, and then any other unanswered questions we'll just follow up with on our blog. And the last question is, how do you see the new crowdfunding rules affecting RBF and angel investing?
Yeah, that's a good question. So the crowdfunding stuff is pretty interesting. I think we're a long way from total open non-accredited, although they did just pass the open solicitation, which is pretty cool. And I think it's great. It could very well be that people do RBF investments. We've had people reach out to us interested in how to structure things with friends and family. I guess my only hesitation there is, like I said, the amortization and the interest in the principal stuff, and that goes back to our experience. That stuff's really complicated, and we've done a lot with it and done a lot of research and a lot of math. So it is a little bit complicated. It's more complicated than just a straight equity investment from angels or friends and that kind of thing. But certainly, all of these things could be platforms, right? If there's, we could open up our balance sheet and certainly offer up revenue-based financing through our structure to the crowd, and that would be, we'd be happy to do that. It's a really well-suited structure for a given set of companies. Like I mentioned early on in our case studies of the VC-backed versus the RBF or bootstrapped, depending on who a company is, where the capital comes from doesn't really matter. It's more of the structure that's the right fit for the company at the right time. So crowdfunding is, I think people think it's an answer, but I would argue that the answer is actually just finding the right source of capital, or the right structure of capital, and the source will be there. If the question or the challenge is access to capital, then I would argue that at least what we're doing right now, what we're trying to do is provide capital very quickly and efficiently and solve that problem that a lot of people think maybe crowdfunding is going to solve. So short answer is, I think it's great. I don't see it as happening anytime really soon, maybe a couple years from now, the true open non-accredited investor solicitation, but for now, we're trying to help solve the same problem, provide capital to growing companies. Anything else?
Let's see. There is another good question that just rolled in.
That's totally
after
fine.
that,
we got nothing to do today.
All right.
This is it, guys.
It's not true.
Yeah, right.
Here we go. This is a great financial product. Do you see banks trying to compete with you?
That's interesting. I don't. Banks are just so. Well, I guess there's two ways to answer that. I don't think banks will ever invest in companies as early as we are. There's just too much risk for how they're structured and all their regulation and everything. So they'll never go, even some of the technical banks, Square One and Silicon Valley Bank, they still don't, they invest in relatively big VC-backed companies. They don't do loans with early stage bootstrapped companies at all. So there's no risk from us on the competitive side for those guys moving down. If anything, it's a good partnership opportunity. Now, could a bank eventually offer an RBF investment? Maybe. That's totally possible, and I think we'd encourage that. I think there's plenty of space in the RBF industry for more players. Like I said, right now there's relatively few, and they're all doing it in such different ways that I'd argue they're not competitive, and some of them are barely RBF. So it's an interesting thing, and I think it's growing. And I think that's the reason we're doing a webinar like this, is the more people that know about it, know of it as an alternative to the traditional sources, the better. Because we certainly are very passionate about it and think it's a really good fit for a lot of companies. All right.
All right.
It looks like that's it. So thank you very much. And if you do have any follow-up questions, you're welcome to email Ann or myself. And we really appreciate your time today and look forward to working with you.
Thanks for joining us.